The idea of stopping to work for money and making money work for you is not new. Investing for income is not supposed to be a riddle either. Toronto, New York, or London, as one Baker Street detective told his retired doctor friend, "Elementary, Watson, you know the method, apply it." So you find some bonds and blue-chip dividend stocks, add liquidity and diversification, buy low, sell high, watch your commissions and fees. You keep winners, identify losers, and keep clipping coupons all along. But if it's all so simple, why aren't we all winning? Stock markets started in the 17th century, and by 1914, the London Stock Exchange boasted trading 1/3 of all public capital in the world. Since the times of Holmes and Watson, people invest pretty much the same way. Sure, we have keyboards, screens, and smartphones, but what we do has not really changed. Experts and brokers in financial districts use their experience and skill sets going through news and research to try to pick tomorrow's winners. They decide what to buy and what to sell based on what happened yesterday and happening today. The problem lies in Mark Twain's observation. Forecasts are tricky, especially about the future, and brokers are no exception. They are human beings driven by emotions, motivated by compensation, susceptible to cognitive biases, and employed by profit-driven corporations. Like the rest of us, they mistakenly associate familiarity with safety, are reluctant to admit mistakes, and tend to show stubborn overconfidence. But the most damaging of all is fear of missing out and looking stupid while everyone else is making money. Deeply rooted in herd mentality, FOMO led to market crashes throughout history. Driven by irrational exuberance, brokers and clients alike are happily stampeding towards higher commissions, exotic alternative investments, and riskier rewards. Until the bubble finally bursts, bear market bust follows. Herd stampedes right over the cliff as prices crash. Income investors learn their lesson, say never again, and inevitably add insult to injury by missing eventual market recovery. There has to be a better way, and there is. This method is so counterintuitive, investment pros call it contrarian. Remember when George impressed his romantic interest by announcing himself as unemployed and living with his parents? That is exactly the approach to popularity that might work in a sitcom, but in efficient markets described in 1952 by Nobel Prize winner Harry Markowitz, that would be an anomaly. And it is. 66 years after Markowitz, Richard Thaler won the same prize for advances in behavioral economics. One of his first articles on the subject was called A Closed-End Anomaly. To remove anomalies, rule-based investment strategies remove emotions from the investment process. Our rules-based Top 50 Index does more. Our system screens funds for management fee, size, liquidity, yield, and most importantly, net asset value discount, collecting income streaming assets free. Finally, we plug in more data and use a statistical indicator called Z-score. It shows how unpopular or popular an asset class is. Twice a year, the index rebalances. The popular, expensive funds get sold. The higher yielding ones discarded by poorly informed sellers get scooped. Now let's talk about the elephant in the room. In near zero rates and GDP growth, cost is everything. We can reassure MER watchers. Net asset value discounts will beat a percentage of assets going to fees by a mile. And then there is a behavioral gap. That name describes a difference in average returns of investors buying and selling funds compared to doing nothing. Doing nothing is okay, but following the Z-score is better. Let's just quote Morningstar and say Z-score can help investors uncover truly undervalued and overvalued funds. To continue this Sherlock analogy, if you'd like us to do dividend discount detection for you, our updates will always be one click of a button away. You'll feel secure knowing what we suggest is not dictated by a need to earn a commission or some emotional reaction. By following our method, we have more time to focus on your needs and help you stay unpuzzled, unstressed, and in control. Bring your frequently asked but unanswered investment questions, and we shall un-FAQ them in no time.